In the blue corner, Chairman and CEO of Berkshire Hathaway, Warren Buffett. And in the red corner, founder of Vanguard, Jack Bogle, whose style of investing is best for you. Good day to you folks. Money Jim here, your money pal. Now when it comes to investing, there ain't many better than these two fellas, Warren Buffett and Jack Bogle. See, Warren Buffett's been so successful at investing for so long, he's become one of the richest folks in the world. And Jack Bogle pioneered index investing no less, and started the Vanguard Group, which today is one of the biggest investment companies in the world. But they both got their success investing very different ways. And to understand why and how, you gotta look at their backgrounds. See, Buffett's been investing since he was a whippersnapper. At college, he was mentored by a fella named Benjamin Graham, who's known as the father of value investing. That's investing in beat-up stocks that can be picked up cheap and then sold for more once the true worth of the company is realized. That's the plan anyway. Of course, it don't always work out like that. Buffett had a ton of success investing this way in his earlier years. Now enter Charlie Munger. See, in the late 70s, he joined Buffett as chairman of Berkshire Hathaway, which by then Buffett was running. Now Munger's view on stocks was very different. See, instead of buying stocks in maybe okay businesses at a great price like Graham did, Munger thought it was better to invest in great businesses at an okay price. And that's how Buffett and Berkshire Hathaway now invest in a small number of high quality companies. And then stay investing in them, ideally forever, to keep them growing and growing over time. And when I say small, I mean small. See, over half of Berkshire's portfolio is invested in just 3 stocks, and about 90% in the top 10. That's pretty darn concentrated. You better know your companies inside out if you're doing that. When you consider Berkshire's got about 400,000 employees, it's safe to say they got plenty enough people doing the research. Now let's look at Jack Bogle. Way back in 1951 during college, some research he did uncovered that most mutual fund managers didn't beat the stock market. And so he hit upon the idea of an index fund. Simply copy the market by investing in all the same stocks, hundreds of them, and in the same proportion. And because you don't need to do any company research or employ a high-paid manager to choose which stocks to buy and sell, an index fund could be offered at a way lower cost than an actively managed mutual fund, and should deliver bigger gains too, more often than not. Now today that's all pretty common knowledge. Don't forget, back then, hardly no one knew, so it was pretty groundbreaking stuff. Anyways, after working his way up through a mutual fund company, Bogle convinced the board to set up one of the first index funds. It took off slow though, and was even criticized for being un-American. But Bogle stuck to his guns, and sure enough, folks started to buy into the idea. And so in the mid-70s, he started the Vanguard Group, which, fast forward to today, is one of the biggest and probably most famous index fund providers in the world. Although health problems led him to step back as Vanguard CEO, Bogle stayed on as chairman till 1999. But even after he left Vanguard for good, till the day he died in 2019, you wouldn't find a bigger supporter of index investing than Jack Bogle. So there's a bit of history for you. Now you can see why Warren Buffett's style of investing and Jack Bogle's are so different. Buffett does a ton of research and only invests what he thinks are the best of the best companies out there. Bogle reckons you don't need to bother with any of that stuff. Rather than looking for the needle in the haystack like Buffett, just buy the haystack and simply invest in all the hundreds and hundreds of stocks out there. But which approach is best? As you can see here, Buffett's Berkshire Hathaway has done a mighty fine job of beating the S&P 500 over time. Since 1981, the S&P averaged an annual gain of about 13%. Real nice. See, with those kind of returns, you more than triple your money every 10 years. Berkshire's averaged about 21% annual gains during that time. With those kind of gains, you'd nearly 7x your money every 10 years. I don't really need to show you how Vanguard's S&P 500 index fund is done. Here it is anyway, and it's no surprise that there ain't hardly no difference between the fund and the index at all, just like an index fund's supposed to. Now you might be thinking, well, that's the end of that argument then. Buffett's way is best. But hold your horses, sunshine, because it ain't a surefire bet. And that's because 1 year in every 3, Berkshire's done worse than the S&P 500, including in 4 of the last 10 years, when it's fallen behind by between 10 and 20%. Or in 2009, when the S&P gave you an extra 24% gain, or 1999, when it gained an extra 41%. Just like any other managed stock portfolio, there's been some real tough times, and almost certainly will be more to come. But of course, over the long run, Berkshire came out tops by a country mile. But here's the thing about Warren Buffett. Man's got some skills, and he's got over 7 decades of experience behind him. And with hundreds and thousands of employees at Berkshire Hathaway, he's got more resources than you can shake a stick at. Just you go trying to replicate that. You won't even come close. See, the thing about stock picking is it takes years and years of experience before you get consistently good at it, and countless hours of research and churning through data and company reports and forecasts. And it also takes a wise head to know what to buy and how much and when to sell, and importantly, when not to sell. Most folks just ain't no good at it. Sure, you might get lucky from time to time. When markets are going up, it seems like picking stocks is the easiest game in town. But as the old saying goes, a rising tide lifts all ships. There's also another saying that Warren Buffett himself uses, and that's when the tide goes out, you find out who's been swimming naked. So when markets drop, all those stock pickers who didn't really have no clue what they were doing learn a real painful and expensive lesson. Now, I ain't saying you can't ever beat the market by picking stocks. You sure can, every now and then. But what's a darn sight harder is beating the market time after time after time. See, if about 80 to 90% of experienced, super smart mutual fund managers with an army of analysts behind them don't beat the market in the long run, what chance do you or anybody else got? Slim as a toothpick, that's what. Now, if all this sounds like a one-sided view on whether to pick stocks or invest in an index fund, y'all know which side Bogle was on. But let's hear what Buffett has to say. Here's a quote from one of his annual newsletters. The goal should not be to pick winners. Instead, own a cross-section of businesses that in aggregate are bound to do well. A low-cost index fund will achieve this goal. And here's another Buffett quote. Consistently buy a low-cost index fund. That makes the most sense practically all of the time. Now, you might think this sounds a bit strange coming from a man who spent his entire adult life picking stocks and doing a darn good job of it too. But Buffett ain't talking to himself. He's talking to you and all the other everyday investors out there. And he ain't just talking the talk, neither. He's putting his money where his mouth is. Because in his will, 90% of what Buffett's leaving his wife is going to be invested in Vanguard's S&P 500 index fund. So there you have it. Buffett and Bogle have totally different ways of investing, yet they both agree the best thing you can do for your money is index investing. Pretty hard to argue against those two. See you next time, sunshine.